Welcome to the Lone Star Capital Podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrouther, Director of Business Development.
On this show, we talk about real estate investing, business,
and so much more. Welcome back to another episode of the LSCRE Podcast. You know, my energy is super high as always, but Rob, your spirits might be really down. I know this is something we got to take seriously here. I know you're such a big cryptocurrency guy. You're a massive Michael Saylor MicroStrategy fanboy. Your life is tethered to cryptocurrency performances, meme coins, things of that nature. There's been obviously a bit of a downturn there. The gains of 2025 have been all but eliminated, or all eliminated essentially. Are you okay? Are you gonna have to mortgage anything? Or are you gonna have to sell a watch or something to make ends meet right now with your levered play?
I'm definitely not okay. I'm very upset that crypto or Bitcoin is flat in 2025, and it's actually up year over year 3.3%, and it's actually up 400% in the past 5 years. So no, I'm not happy. I'm very upset. I will only be happy once Bitcoin is zero, and we have a long ways to go.
Can you explain your qualm and beef with Bitcoin?
No, I don't really have I just think it's not worth anything. I don't really understand it, so I don't invest what I don't understand, and I think it's kind of a grift. It doesn't really make sense. It's not, if the whole point of it were to be anonymous and decentralized, that part of it has failed because, the government is going to basically usurp it and take advantage of it to create, centralized currencies, and it's all public and it's all there on record. So it's actually not this private decentralized thing. And then if it is a medium of exchange, well, nobody's using it really as a medium of exchange, and a medium of exchange needs to be stable prices, and Bitcoin is the opposite of stable. It's the most volatile asset in the world, so it's not a stable price, and therefore you would not use it as a medium of exchange. So it's not a medium of exchange. It's not private and decentralized. So what is it then? It's basically the new gold, except what purpose does it have? Gold has purpose, right? Gold, you can make jewelry out of. Gold, it conducts, right? It's used for many things. And what is Bitcoin used for? I don't know. So that's why I think it's not for me.
Well, hey, one of the twins, the Winklevoss twins, well, what if an asteroid comes down with all this gold and gold all of a sudden, or we start mining asteroids for gold, gold will become useless overnight?
It won't. It'll just go down in price, but it won't be useless. It will still have utility.
No, it'll be devalued though. But Bitcoin, there's only 21 million of them.
Yeah, it's true. There's only 21 million of them, I suppose.
Yeah. Well, with that said, everyone, please join us on our live webinar on December 4th at 2 p.m. We're going to be going over a financial breakdown and case study for some of our, specifically for a couple of incredible assets of ours. So you don't want to miss that one. We got a fun agenda today. First things first, everyone has been crashing out. Maybe not everyone, but some people on the internet have been crashing out over the thought of not Bitcoin, but 50-year mortgages. And I think people are not understanding. I understand at first, you're going to be a debt slave or whatever, but a 50-year mortgage and the purpose and why you should utilize this if it's available. So on that note, naturally, there's been some talk about that, portable mortgages, things like that. So we're going to talk about just a 50-year mortgage and why I think people are mentally challenged to not understand the larger picture on this one. So number one on that, people are, we're going to pay so much more interest over the life of the loan. Okay, well, guess what? A lot of people who are having affordability issues to buy to start with, gets you theoretically immediate relief by your payments being 20 to 30% closer day one. So now close your eyes and think about something. In 10 years from now, will you be making more or less money? In all likelihood, more money. So what does that do? And will inflation occur? Likely yes on both of those. So will your 50-year mortgage look better over the time value money perspective? Yes. The other thing to think about is the typical mortgage is probably refinanced within 10 years at least with certainty. So you're going to be resizing this mortgage, over a 10-year time. Your wages and salary might go up 60 to 80 to maybe 100%. in some instances. So then you can right size that debt into, I don't know, a 30-year mortgage, a 20-year mortgage, whatever it may be. You're going to resize that piece of paper over the course of time. And most people sell and move every 7 years regardless. So people are freaking out over something that's really a nothing burger in many respects. That might give, that Gen Z person, that millennial individual, the opportunity to buy into something because now their payments are incrementally cheaper and are more competitive to, rental housing right now to make that deal a little bit, make a bit more sense. Also, when the economy is not very good, particularly relating to the housing market, this gives an incredible trickle down effect to the economy with movers and every other, movers, home services, lenders, realtors, everyone that kind of works, furniture company in that space, home improvers, contractors. All of a sudden, the economy and market will move a lot better when the housing market is moving and more fluid. And this could get, potential would-be renters into would-be buyers. So overall, I think it's net accretive. But Rob, I know you had a couple takes on this as well.
Yeah, it's a filter for people who either understand finance or they don't. And it's very funny because people think, oh, 50-year mortgage, this is indentured servitude, and you're going to be paying off the mortgage your whole life and all this sort of stuff. But really, it's just so funny because we, as borrowers in commercial real estate, we negotiate and we push so hard for our lenders to give us 35-year amortization instead of 30-year, for example. And so why is 35 years more advantageous than 30 years? It's because it reduces our monthly payment when we're paying principal and interest. And why does it reduce the monthly payment? It's because it's going to take 35 years to pay off the loan, because every month you're paying down a portion of the loan over a 35-year schedule instead of over a 30-year schedule. And so that makes your monthly payment lower, which is great for us because we're looking to maximize cash flow for investors. So people don't understand the time value of money. They also don't understand that finance is a spread business. So if you're borrowing for a commercial real estate property, if you're borrowing at 5%, but you're investing in a property that is generating 6%, that's a positive spread, and you're actually making money for every dollar that you borrow. So the borrowing, it's actually, as they call it, good debt versus bad debt. I understand that a primary home mortgage is a little different because it's not an income producing asset, but you are an income producing asset. So you yourself can actually reduce your payment, and then that frees up cash flow to allow you to do other things with your life that have a higher ROI than the cost of the interest of your mortgage. And also those can be non-financial returns too. For example, you might derive a lot of joy from going out to a restaurant once a month extra because you have a lower payment. Yes, it will take you 50 years to pay off the mortgage, but you get the time value of money. You get to, and I know that's a less concrete example, going to a restaurant, because it doesn't have financial ROI, but quite simply, if you invest in the stock market historically returns, let's say 7%, 8% returns every year, right? So if instead of putting that money every month into your mortgage and paying down the mortgage and paying back the lender, you could put it into the stock market and make 8% when your mortgage is only 6%. So you're making money. Now, that's not necessarily in practice how I would advise someone to live their life necessarily, but those are the concepts of finance. And in finance, there's a very simple concept of term risk. So if I lend money out, if I'm the lender, the longer I have to lend the money out, the more risk I'm taking of getting paid back. And the longer the amortization schedule, the smaller the increments I get paid back in, right? So if I loan you money, if I loan you 100 grand for 10 years, I say, Craig, you could pay me back in 10 years. I'm taking a big risk because a lot of things could happen in 10 years. There could be rampant inflation, which wipes away the value of my 100 grand, especially if I'm locking in myself to a fixed rate. Or you could default within that 10-year period. Lots of different things could happen. So it's just hilarious because I made a video about this and someone commented this morning, much more favorable to the mortgage lender, not the borrower, right? And so
You're a moron.
You're a moron. The reality is, if let's say I loaned you 100 grand, you want a 100 grand loan, I'll give it to you for 2% interest, right? You'd say, yeah, I'll take that loan. That's amazing. It's cheap debt. But I say, you know what? But the amortization schedule is 6 months. So you have to pay me like, I don't know, 15 grand per month back. It's like, well, it's not even worth borrowing the money in the first place because the amortization schedule, the payback period is so short.
You're a loan shark.
Yeah, so basically that kind of proves the point that the longer the term of the loan, the better for the borrower. The shorter the term, the better for the lender.
Yeah, I just find it really silly. All the hoopla regarding that. Also, the other thing I thought about this, and I actually the thought dawned on me right now. If you're living in an area that's got incredible schools, right? I live in Arizona, 48th state in the country for schools. Not very good. However, let's say if I lived in the Bay Area, right? And I could now take out a 50-year mortgage, but now my kids could benefit from the best school district in the area because now these payments are more affordable. And instead of having to send my kids to private school, I can send them to public school by proxy of where I get to live and go here. That's an incredible benefit. Let's say if you live in Texas where property taxes are really high and you want to be in a certain school district or whatever it may be, maybe there's great public schools or somewhere in Florida. Now you might be able to do that and to move to that location and get into great public schools and stuff that are you're going to be paying for regardless. Now you get the option to potentially do that. So there's so much more to this equation than just that people need to factor into. And yeah, sure, you're not going to be paying down much there, but you also collect 100% of the upside if the property appreciates, right? So I think people are totally missing the picture.
If
However,
people
there's
don't
one,
like the 50-year mortgage, why don't they just buy all cash?
yeah, sure,
Why,
or do a
why don't,
20 year, do a
if
20-year mortgage.
See, like someone the other day told me, "Oh my gosh, a 50-year mortgage, imagine how much interest the bank's going to make. The bank's going to get another extra 20 years of interest." Okay, well then just buy the deal all cash then.
Yeah, yeah, or you know what, do a
Don't
20-year
pay
mortgage.
any interest to the lender.
Let me explain to everyone something real quick here. When I bought my house before, okay, I took out a $720,000 loan and I'm refinancing my house as we speak right now or working that process. And I asked, hey, out of curiosity, what's my loan amount left? And it's 717 and $500,000. Okay, so I've paid down approximately $2,500 in a year plus span, or a year and a half almost. Okay, so just goes to show you're paying a lot of interest in any loan the first really 10 years, any way you slice it. So, but guess what I got in my past house? 100% of the upside. Guess what I have in this house? 100% of the upside above that loan amount in my purchase price. Okay. So it's a very good deal if you can make those payments work.
So,
However, if I'm going to be empathetic to the potential young buyer, if this is really about Gen Z and millennials not being able to get into the price, should there probably some sort of government subsidy or some sort of first time exemption where not an FHA, but you get some, really accretive interest rate to help young people get into the game so they feel like they can have a fair chance, despite the fact that a home may not be the best idea, but for them to play house and have the American dream. Sure, maybe there should be some sort of, benefit based on, where mortgages are at to allow them to kind of buy into it on a one-time basis. And if they sell that house in the future, they don't get to reap that benefit, but they get it once and then they can go from there. And that can only be on your primary. Maybe that's some sort of a middle ground solution, but obviously that's way too logical for a government to implement.
so you mentioned something that I don't think a lot of people actually totally get is an amortization schedule, because when you pay off a loan in just a fully amortizing or self-amortizing loan scenario. And when I say self-amortizing, what that means is that the loan term is equal to the amortization schedule. So if you're amortizing a loan on a 30-year amortization schedule and the loan is also a 30-year term loan, that means that there's no balloon payment. So when the loan comes due 30 years from now, it's actually zero. You've paid it off. So there's no balloon payment. But that never happens in commercial real estate. When we
No.
borrow, let's say, a 5-year loan or a 10-year loan, those amortize on a 30-year schedule, if they amortize at all, because the most sophisticated commercial real estate owners, investors, they actually borrow interest only, which means that they never pay down the principal through the life of the loan. So when we go, like for example, we just closed on a $44 million deal. We borrowed about a $28 million loan on the property. That $28 million loan is a 5-year term at a 5% interest rate. Over the course of the 5-year loan term of that $28 million loan, we are going to pay $0 toward principal. The entire life of the loan, we are only going to be paying interest every single month, 5% or less, zero principal. So the savviest and most conservative investors in real estate, they actually don't pay principal at all. So if you're complaining about a 50-year mortgage, try an infinite mortgage. Try a loan where you never pay it down through the life of it. So that's really what the smartest people do. So smart people would kill for a 50-year mortgage. So, and let me share my screen here real quick. Let's go like this. So I just Googled a very basic amortization schedule here. So as you can see in period one, we'll call it year one, $21,000 loan. And the payment is comprised of interest and principal. And so this is kind of a bad example because this is amortizing on an 11-year schedule. So this is a very fast, very aggressive schedule. Normally you would not pay off a loan in 11 years. This is very
it's
fast.
terrible. You got to use like a more conventional 30-year one for the purpose of the example, I would say.
True, but I've got this open already. So
Classic.
we'll just have to make it work. So, but the point still stands is that in the
That's just an accelerated example of essentially what's going on here to make the point. But also the other issue is that the shorter the loan, like if you do a 20-year debt period, you're paying substantially less in interest, substantially less. So I'm looking at a 10-year ARM right now, so it's fixed for 10 years. At the end of that 10-year period, I will probably right size that sucker into a 20-year loan or a 15-year loan because time value of money. I'm very confident in my future earnings. I'm very confident that the paper that I own today will be less valuable due to inflation. So that's why I'm doing this decision today.
So you're taking a more savvy, more financially literate approach, although a more aggressive approach in essentially maintaining debt rather than paying it down, right? The American dream is to buy a home, perhaps with a mortgage, but then eventually pay the mortgage off to where you own the home free and clear. And that is a very beautiful dream, but it's not a financially astute dream. And not every move you make in life has to be financially optimized, right? I think it's a very admirable thing, and I personally do dream of owning a home with no mortgage. That's beautiful. But for the purposes of maximizing returns, for the purposes of financial literacy, you are in fact better off of reborrowing debt on your home and maximizing that cheap leverage. It's the cheapest debt capital that Americans can access. The average American can access.
Debt ever
The
is
best
a
debt
30-year
ever.
mortgage. And now the best debt ever might be a 50-year mortgage, to be honest, to all you suckers out there. So don't be
Seriously.
a sucker.
Seriously.
Yeah,
So
it is an emotional equation to want to own your house free and clear. I want to do it. That is an emotional thing. That's not a logical thing because the arbitrage play of, let's say if you have a house for a round number, $500,000 and you whatever the difference is, I'd be better off putting $100,000 into that home and putting the $400,000 into the stock market or other investments as opposed to all in one thing.
So just to use this as an example, right? The first period, you're only paying $1,300 in principal, and then in the final period, you're paying $2,600 in
And
principal.
let me tell you something. On a 30-year schedule, it is a peanut that you're paying to your principal. Like literally like a quarter of a peanut.
Yeah. So it's a much more dramatic example to where, the first year you're paying 1% to principal, and then it just grows over time, and eventually you're paying mostly principal and less interest. But anyway, I digress. I think that's enough of that point.
Okay, there's an LA rent control topic you wanted to speak on.
Yeah, so I actually didn't do any research for this, so I'm totally unprepared, but I just heard it in a couple different podcasts, basically that there was this new rent control bill or law or whatever passed in LA that now limits the annual rent increases that landlords can do to a maximum of 90% of CPI with a ceiling of 4%. So that is insane because CPI is typically 2 to 3%. So basically you can max raise rents about 3%, which, I mean, that's good, but that's to have as a max is very tough. And it's pretty, and also CPI is often 2%. So now you can only raise your rents less than 2%. So that's just going to be very problematic for LA. And it's really scary to see rent control laws like this pass with overwhelming majorities because the data is just so negative on rent control. Really the only way to cure affordability is through supply. You have to build.
Yeah, well, I will say one thing. It is kind of insufferable listening to everyone on the All In podcast talk about real estate. But they did say one thing that is true, that if you want to make things more affordable, you build a lot more supply. Now, look at the Sunshine States. Those places are thriving. Jobs are moving there. Companies are moving there. The bureaucracy and restrictions and red tape to businesses and things of that nature is substantially more accretive there than it is in the lovely coastal markets that people like yourself and my family elect to live in at the moment. but places are a lot more affordable in those kind of sunshine states, southern areas, and that's because they are flooding the market with supply because you're actually able to build. There's not all of that. And what these people have totally butt backwards is they think to combat this, they're gonna kind of create rent control. What they're gonna do is just have a lot of owners, eventually sell off their dilapidated apartments, and the tenant's actually gonna be the one with bad service, with things that are not going to be working and not going to be fixed because people do stuff based on incentives, and if there's no incentive to improve the structure of the property, why would you do it? That doesn't make any sense. If it's not a financially beneficial or savvy move, you just are not going to do that. So ultimately, this is really sad to see, but this is exactly why people like us are looking to acquire properties in more market friendly, landlord friendly places. And landlord friendly is such a joke because, quite frankly, it's not really landlord friendly as much as, hey, the rules for you and us are equal. It's not a completely lopsided affair and equation that's inappropriate. So we want to be in those markets where it is appropriate.
Yeah. I don't know if I have really much more to say about the LA rent control. It's sad to see, but it is better for us where, like you said, we're investing in non-rent control areas, and you're going to imagine more capital is going to leave LA. So there's going to be less people who want to build in LA, less people who want to own. So they're going to take their money and invest it in the projects that we are doing.
Yeah. With that said, New York, Mandani, your boy, got elected. So do you think he's gonna be able to get his, ideas passed through?
I don't know. I don't think so. I think people are overdoing it as far as the reaction goes. New York already has some pretty crazy rent laws and stuff, so we shall see.
Yeah. There was a Lennar article I know you wanted to speak about as well. If you want to pull that sucker up, screen share, or basically give everyone the gist.
Oh gosh, I'm so unprepared. I don't know. I'm not gonna. It's there's no need to screen share. It's just words, right? And so basically, Lennar is one of the largest home builders in the country. They just released this new Lennar Investor Marketplace, which is a super innovative, cool idea. Basically, where Lennar, this prolific home builder, they've built over 1 million homes in this country. They are now building homes specifically for rent and for you to buy as an investor and rent out. So it's actually a very interesting smart play because Lennar is understanding that the average person who typically was the home buyer in this country is now too poor to buy a home. So they need to create a new customer for their product, which are homes. So they are going to build homes now for rich people because there's a bunch of rich people that need to do something with their money. Say, hey, we're going to build a home. Instead of a family buying it and living in it, why don't you buy it and then rent it to the family?
So it's basically more privatized build to rent, is what I'm hearing.
Yeah, it's more individualized build to rent. And what's cool about it is you typically think of a single family home investor as buying a fixer upper or buying a flip, and they just quickly buy it, fix it, sell it. But in this case, you're buying from Lennar, you're buying a brand new home that was just built. And some of these are in very good locations, and you can kind of just have a turnkey solution where you buy it, you finance it how you want, right? So the great thing as an investor for these is you buy it yourself. So you own it ostensibly yourself with no partners. You have all the control. That's a plus. You can finance it how you want. That's a plus, right? So if you're investing with us and you don't like the debt structure we're putting on the deal, that's too bad. You can buy your own Lennar Investor Marketplace home and you can finance it how you want.
$44 million deal.
Yeah. Or you can, buy a $600,000 house cash if you want, and that's your deal. You obviously have to be wealthy in order to do that and stay diversified because that's a big chunk of change. But basically, that's kind of the premise of this. And the takeaways that I find interesting are Lennar has this underwriting calculator built into the marketplace to where it's like, okay, here's the home, and the home's in Tampa, and the historical previous 5-year price appreciation for this home area is 8%. So if you underwrite to 8% price growth over the next 5 years, you're going to get a 17 IRR. So people are going to be looking at these homes. They're going to say, I can buy this brand new, beautiful home in this good area, gated community, and make 17% IRR. This is amazing. I'm going to do it. And,
It's
obviously
so easy.
if you toggle the leverage, like you say, well, I want to use a little less leverage, right? It'll bring that 17% return down. But overall, those are exciting numbers, right? You're taking very low risk, right? It's great, high quality location and asset, mid high teens returns. What's not to like? Well, what's not to like is the base case scenario, the way that they set these pro formas up is that you finance the house with 75% LTV. And based on the dynamics, as far as we just showed a chart on our last episode about the cost of renting versus the cost of homeownership, what does that mean? That means that Lennar is projecting when you buy this house, you're going to have a cash on cash of negative 8%. So every month you're going to be writing a check to the house so that someone else can live in it. And in the hopes of the property going up in value when you eventually sell it in 5 to 10 years from now.
This is what you call negative leverage. And it's actually really funny. On the last episode as well, you heard me allude to this, but talk to a guy who's, for all intents and purposes, smart, successful guy, he's done well. He's like, yeah, I like this deal, but just not really a home run to me on the deal we're raising for. I'm like, okay, I totally understand. He's like, yeah, I like deals more than they're like an 8-9 cap. Yeah, me too. It was probably really cool. And to further that point, people used to be investing in markets like Phoenix, like places in Texas, good growth markets like Nashville, stuff like that, at the 1% rule, basically meaning that if you bought a house for $200,000, you could get $2,000 a month for rent. And some people even went as far as to say that, yeah, we actually like the 2% rule, which is you could buy, a $200,000 house and get $4,000 a month for rent. Those days are over.
That's called war zone underwriting.
Yeah, this is not
you
how
you get the rent, you get that price to rent ratio in Gaza.
Yeah, exactly. Yeah, amongst other things, I suppose. But that said, people who had these old equations and had it really an easy street back in the day, it really must have been nice. And I hope you held on to these assets. But quite frankly, these things just do not exist anymore. And, people used to drive around and buy stuff and there was no market for it. Well, the internet has totally changed things. And there's such a thirst for American real estate and also to be out of public markets that, these investments also factor with depreciation, are just a lot more handsome. But, overall, obviously more supply has been built, but it's just really silly. The old way people used to invest and to make money, like it really must have been nice. Like making dollars back in the day seemingly was a lot easier.
So you mentioned something, you said that's called negative leverage. And actually that isn't negative leverage. That's negative cash flow, right? And there's a difference. A lot of people misconstrue them and they think they're the same thing. And so negative leverage,
to imagine it's going in.
It is of course negative leverage, but it's like the fact that a square is a rectangle, but a rectangle is not a square.
Sure.
So because you can have negative leverage, but still have positive cash flow. And that's sometimes people don't fully get that, because you could buy a property at a 4 cap and you could finance it at a 5% interest rate and you could still have positive cash flow. It just would mean you'd have to use less debt. And let me tell you something, the best real estate in the world is purchased and financed on negative leverage. That's it. If you're looking at all the best properties, all the best locations, if you're looking at buying irreplaceable real estate, multifamily complex right on the beach in San Diego, if you're talking about, prime, whatever, New York City, class A plus trophy office towers, right? Those are all negative leverage because you're paying a super low cap rate and you're financing at a higher interest rate. So if you actually want to buy the best real estate investments, you actually have to use negative leverage. So anyone out there
in Oklahoma City,
sure. Anyone out there who's hustling and waiting around for positive leverage, like, oh, I want to buy at a 7 cap and finance at a 5 cap. It's like, well, it's going to drive you to make bad decisions because you're going to buy lower quality real estate in worse locations and you're going to actually do worse over time. The best real estate is actually lower cap rate, lower leverage, negative leverage, and rich people, they don't want cash flow. Rich people actually don't invest for cash flow. This whole notion on LinkedIn, like, yeah, I invest for cash flow and I want passive income and I want to retire my W-2 and replace it with cash flow. Like that's what poor people think. Rich people.
Wait, you could grift Max. You could grift Max and get Section 8 in Iowa, like someone pitched you on. Hey, these are great deals.
Sure. So
you want to break down that pitch? The grift Max.
No. Maybe after I make this point. So basically, that's how poor people think. Rich people, they don't need more money. They don't need to supplement their income. They don't need more cash flow. Rich people are rich, right? They have money. They don't want to lose it. They don't want to be dumb. They don't want to look foolish. They want to save it. They want to grow it appropriately over time. They want to beat inflation. And that's actually not hard. That's actually not easy to do. A lot of people think, 10% return, that's low. I want a 20% return. I want to 2x my money in 5 years. It's like, well, that's how people lose money. Rich people are smarter than that. They understand that, you know what, actually over a long time scale, like 10, 20, 50 years, just simply outpacing inflation and having my money worth today what it was 50 years ago is a good return. 5% return, that's a good return if you can keep it up for 50 years. So that's the reality. And that's best done when you buy high quality real estate that compounds over time. And it's actually better from a tax perspective when you have less cash flow because you're creating less taxable income. That's my anti-grift maxing rant.
Do you want to grift max and talk about the pitch you got?
No, what pitch are you talking about?
You know what I'm talking about.
No,
a certain friend of ours had a business that was such a good model.
I don't know what you're talking about.
I don't want to put this on air.
I mean, we've been pitched a lot of things in a lot of places, but I don't know what you're talking about.
Check your text.
Oh my goodness.
Yeah, you know exactly what I'm talking about. That was a griff max.
Oh,
do you want to share now the premise of that?
I mean, yeah, it's just exactly what we're talking about. It's like, hey, do you want to invest in really low quality properties with, basically where you wouldn't want to hang out at night, you wouldn't want to get within 10 feet of these tenants, and we're buying these properties at a million cap, and like, I don't know, it's like, and we're gonna
great cap rate compression on that, right?
We're gonna
especially when you buy deals in Indianapolis.
It's like we're gonna flip the property too, right? So we're gonna put $6,000 per unit into the property and then raise the rents by $200. And these tenants, by the way, don't have jobs, but they'll accept the $200 rent increase.
Makes sense. Grift max.
And then we're gonna project to deliver to you, the investor, 35% IRR. And it's like, well, if the return was that good, you probably wouldn't be struggling to raise money, and you probably just do it yourself. You probably would borrow the money and take on debt capital so that you get all the upside. And
you'd arbitrage max.
You'd arbitrage max. So anyway, there's a lot of that out there.
Yeah, we are doing the exact opposite. We are doing the get wealthy with certainty play with about 35 to 40% LTV, LTC. Full term interest only from the best and the greatest debt sources with awesome equity providers. If you are looking to get involved in any of our offerings, please reach out to me, CRAIG at LSCRE.com, to learn more about us. And please, please, please join us on our live webinar to go over financial reporting, case studies, and review on December 4th at 2 p.m. Eastern. For everyone who's listening, we appreciate your time, and we'll see you next week.